My name is Mark LaMonica. I look after the individual investor business here in Australia for Morningstar. And today we're going to talk about asset allocation. So how do you decide what your asset allocation should be? So hopefully an interesting topic. A couple of things first. You can listen to our podcast. You can follow us on Instagram. And we just put a new post up. I just put a new post up, which is quite an accomplishment because I'm not very good with social media. Also, our conference is coming up a week from Thursday. So particularly with everything that's going on in the market, seems like a good time that maybe you'd want to listen to some people talk about the market. So we've got a great lineup. You can go on to the event registration there to see all of our speakers. And yeah, if you want a discount ticket, you can email me. The other thing is anyone who registers for the conference will get access to all of the recordings from all of the sessions for 30 days. So you don't have to watch the whole thing the day of the conference, although it'd be great if you did, because then you can ask questions. But you can access those videos for 30 days, which is helpful, I think. All right, so we got to go through our housekeeping items, of course. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP on our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. What we would like are questions. So if you have any questions, you can pop them in the chat, put them in the Q&A. And as always, at the end of this webinar, sometime later today, we will send out a copy of the video, obviously, the recording of today. We'll send out a copy of the notes, including a little quiz. Although I feel like today's quiz, well, you take it. Let me know what it goes. The material, then some of the relevant resources that I talk about as well. So there we go. So why don't we go ahead and get started? So as I said, we're going to talk about asset allocation today. So anyone who joined the last couple of these, hopefully you're sensing a theme as we are going through some foundational steps like creating goals. That's what we're talking about. Here we are, how to select your asset allocation. So we started with creating goals. So both just regular goals and of course the nuances around retirement goals. Now we're going to talk about asset allocation, and then we get into picking securities. And why do we want to go through this process? Because we ultimately want to pick securities that are right for you. Not something that somebody tells you on some investing board, but something that is actually going to help you achieve your goal. So that's why we want some structure to this process, particularly what's going on with markets right now. Structure is important because it means you know you have a plan and that your plan is designed to meet your goals, and you can let market noise be market noise. All right, so just a little refresher of what we did. Why do we set goals? We set goals because that allows us to focus on our risk capacity as opposed to our risk tolerance. So once again, our risk capacity is the amount of risk we need to take on in order to achieve our goal. Our risk tolerance is some hypothetical way that we would respond to markets going down like they are right now, for example, but really has nothing to do with your goals. Then we calculate a required rate of return after we've defined that goal. So what is it going to take for us to get to where we are, to where we want to be, including our savings and what we need to earn on our portfolio? So that required rate of return is really the mechanism for getting our risk capacity. So that is how feasible our goal is, and also the amount of risk that we need to take to achieve our goals. And this is what we're going to talk about today. That goes into asset allocation. So as investors, we deliberately take risk, and we deliberately take that risk in order to earn a return, which is, of course, because we want to accomplish our goals. So that's everything we're going to talk about today. All right, as I said, as investors, we exchange risk for return. They say there's no free lunch. There is no free lunch, right? The returns that you are getting from your growth assets like shares are because you're taking on risk. And when we talk about risk in the investment industry, we are talking about volatility, how much the value of shares bounces around. Now we're seeing volatility right now. And just remember, what is happening now is the price we pay for the returns we get over the long term. And if we are long-term investors, we shouldn't care about what's happening now, which I understand is easier said than done, but something to think about. This is why we get high returns. What is happening in the market now? If you're out there feeling nervous about what's happening, well, that is the risk. That's the risk that we're taking in order to get the good things, the benefits out of investing. So let's use a couple examples here. We'll start with cash. So remember, when we're defining risk as volatility, how much prices bounce around, on one end of the spectrum, we have cash. So cash has no volatility. So you can put your money in the bank and you go back the next day and the same amount of money is going to be in the bank. The problem, of course, is over the long term, real returns, so when we take inflation into account, are very, very low. Real returns are negative now with cash, right? We have inflation rates that far exceed what we're getting on cash. But there's no volatility. If we move out to the opposite end of the spectrum with shares, shares have very high volatility, but of course you are rewarded with high long-term returns. So just remember that is the trade-off we're making as investors. And when we do invest, we want to make sure that we are compensated for the amount of risk we take on. Okay, we're going to use two examples to walk through the relationship between risk and reward. So two different ETFs I put down there. So the Beta Shares Australia High Interest Cash ETF. I went back and I looked at 5-year periods. So this is our first ETF. Our second one is Vanguard Australian Shares, which is the ASX 300. All right. So annual return. What do we get here? Not very much on cash. So for 5 years, 1.37% annual return. We had a standard deviation, and I'll explain what this means in a second. We had standard deviation of 0.21. Vanguard Australian Shares over the last 5 years, almost a 10% return per year. And we had a standard deviation of 14.28. So if you don't remember what standard deviation means, or you never learned what standard deviation means, we'll talk about that for a second. So very simply, standard deviation is a measure of risk. So you can read the definition right there. So basically what we're looking at is we're looking at, as you can see, the variation dispersion of those return values versus the average return. So if we're looking at a 5-year period, what has the average return been per year? You can see them right here, 1.37% and 9.90%. So when we're comparing a standard deviation to that average, we are comparing one standard deviation, for example, is adding 14.28 to 9.90. And what we know about statistics is 68% of the time, a return will be in one standard deviation of the average, and 95% of the time, the return will be between two standard deviations of an average. So very simply, and if you just want to look at standard deviation, don't want to go through all this process, just know that higher means more volatility. So what are we doing? So this means if we add 0.21 to 1.37, we get 1.58. If we subtract it, we get 1.16. That means 68% of the time, that's one standard deviation away from that average annual return of this cash ETF. So 68% of the time, you're going to get a return between 1.16 and 1.58. 95% of the time, we'll get it between 0.95. So that's two standard deviations. So that's 0.21 times 2, so 0.42, and 1.79. So what is that telling us? That's telling us as investors in this low volatility cash ETF that the vast majority of the time, we are not going to get much upside. We're also not going to get much downside. So we kind of know where our return is going to be most of the time. And that return is a pretty tight band, right? Because this 0.21 is low. Vanguard Australian Shares ETF. So 9.90 annual return. So that's good. But look at how high the standard deviation is. So what does that mean? It means the return is going to bounce around a lot. So, right, when we look at two standard deviations, or 95% of the time, we can see a huge variance, right? So you could lose, you can obviously lose a lot. There's that 5% of the time, that's the tail. But 95% of the time, you still have the possibility of losing close to 19% a year, but also could have a huge upside. So that is an example of volatility and returns. So anytime you go and look, and where did I find these? I found these on our website. They're also on the website of the ETF provider. So standard deviation is generally something that you are going to get as any sort of measure. I would say most people probably ignore it. You don't have to think too much about it. Just remember, higher is more volatile. So in investing, we are exchanging this return, this 9.9%, for increased volatility. And we need to think about what all those implications are as an investor. And what the implications are, very simply, and we'll go through an example in a second to demonstrate those. What the implications are is that we need to take on risk. We need to go through what we're going through now for over the long term for getting high returns. So there's no free lunch with investing. All right, we're going to go through a case study. So this is Julia. Julia is a real person. So Julia is a friend of mine. We actually were down in Melbourne this weekend going to the tennis. She recently turned 30. That is Julia's birthday cake. This is her actual 30th birthday party. And fun fact, that's me with the beer. But anyway, Julia's 30. She wants to invest for her retirement, describes herself as conservative. So you talk to a lot of people about just what they are. A lot of people will say conservative, right? Seems like a good thing to say as an investor. So a lot of people, as a lot of people are right now, is worried about losing money in the share market. But also she's got this retirement that she wants to do, right? She wants to travel a lot, and she knows that that's probably going to be expensive. And so she thinks in her head, she needs a good deal of money to support that lifestyle. Now, like most people, right, in this case, Julia has not defined what that money is, but just thinks travel, that's expensive. I guess I need a lot, but hasn't really bothered to think through anything, and probably hasn't thought through calling herself a conservative investor, but nevertheless, there she is. All right, so we're going to try two different approaches. And remember, we talked about this before. We are going to determine her asset allocation, which is the exercise we're going through today. We're going to take a risk tolerance approach. That's where we're looking at how much risk she can tolerate. And then we're going to look at a risk capacity approach, which is what level of risk is actually needed for Julia to meet her returns. And I don't know if Julia's watching. I told her that I was going to talk about her today, but she is busy. So we'll see. I'll send her the video afterwards, see what she says. She's probably sick of me after spending a weekend with me in Melbourne, but we will see. All right. So Julia takes a risk tolerance questionnaire. A risk tolerance questionnaire has all these questions, and here's an example. Julia had $20,000 to invest over 10 years. Which portfolio would she prefer? So she's supposed to just go through these answers and find out and pick which one actually applies to her, right? No other information. She'll get all these different questions, all basically asking the same thing. So Julia just reads through these and she goes, I don't know, B sounds okay. Remember, she's conservative. And she's sitting there and she's thinking, okay, losing 20% of her portfolio seems like a lot, right? And she's thinking, I don't know if I could actually tolerate that. And she's doing something logical, right? She's saying, all right, if I lose 20% and I only get 2% more a year, that trade-off doesn't really seem to work for Julia. Right. So she hasn't really thought it through. There's, of course, no calculator to show her what any of this means. So Julia's just kind of sitting there thinking, okay, well, I'm conservative. I'll pick B. All right. Then Julia goes onto premium and spends some time actually thinking about what she needs. So we went through this exercise last Tuesday. So in that second webinar video, if anyone wants to go back and watch that, if they did not see it. So she thinks about her goal and she thinks, okay, I need $90,000 a year to support my retirement. So she thought through, okay, what does traveling actually mean? What does she want to do? How much money does she need? Okay, she wants to use a 4% withdrawal rate. Because she attended last week's webinar, she thinks, okay, so all I have to do is divide the two, all right? So she's a portfolio value of $2.25 million. She's got $100,000 right now, and she's going to save $15,000 a year. So she calculates what it's going to take to get to her goal. right? So now she's thought through her goal. She's now calculated what return she's actually going to achieve, and that return is 7.1% a year. All right, so, okay, now Julia's spent some time thinking about that. Let's look at where she would be from an asset allocation perspective in both those cases. Now, I am using a very simple asset allocation here. We'll get into a more complicated one in a second, but I want this to be illustrative of the point we're trying to make. All right, so we're doing a 2-asset portfolio. She can invest in Aussie shares and cash, right? What we looked at before was Aussie shares and cash, right? That Vanguard ETF and that Beta Shares ETF. Now, what we're looking at is forward projected returns. I'll spend some time talking about these in a second, but our investment management group has projected forward returns, which I will share in a couple slides, on lots of different asset classes, but I picked 2. So what are they projecting? They're projecting over the next 10 years, Aussie shares will earn a little less than 8%. Cash will earn 1.75%. So for those of you that remember a couple slides ago, this is lower than what the Aussie shares have earned. And we'll talk about this in a second. And this is actually a little bit higher. And they've also projected standard deviation. So this is pretty similar. This is actually a lot higher. But they've done that. Now you know what a standard deviation is, right? So we talk about variation. So we'll get back into those returns, projected returns in a second. All right, so using her risk tolerance questionnaire, Julia selected a portfolio that has a 37% allocation to Aussie equity and 63% allocation to cash, right? And that gives her, if we actually do the math here, so if we go into Excel and screw around the different allocations, that gives her about what she's looking for, right? So what was on that risk tolerance questionnaire? So she's going to get an expected return of 4% a year, right? Remember, that's what she's going to average going forward. If we go back and look at this risk tolerance questionnaire, this is what she got. Yeah, 4% a year. Okay. And of course, we see our standard deviation, 6.84. So what does this mean if I actually project this forward into Julia's retirement? Well, it means that she's going to end up with $1.17 million, giving her savings rate, given that expected return, which means she is a whopping $1.08 million short of her goal. So not a great situation. Julia basically has half as much money as she needs to achieve her goal. So that's not great. So what has Julia done? Whether she's done this consciously or not consciously, she has decided that she is going to minimize short-term volatility because she's worried about her portfolio bouncing around in value. And by doing that, she is guaranteed that she won't achieve her goal. Now, of course, if this was framed to Julia differently, she would not have picked that option. But it wasn't, right? Because it was just talking about risk tolerance, how much risk she can tolerate, not how much risk she needs to take. And incidentally, just so everyone's aware, generally, when women take this, they pick more conservative options and men pick more aggressive options. Now, obviously, the outcome that men and women are looking for, on average, is not any different. So there are some gender biases in risk tolerance questionnaires. And then when you top that up with the gender bias of many advisors who put women into more conservative portfolios, even if men and women answer the exact same question, you run into problems. So Julia's running into a pretty standard problem here. All right, so let's say she picks her required rate of return. Now she knows she needs 7.1% a year. So once again, if we look at those expected returns, Julia would allocate 88% of her portfolio to Aussie equity, not 37%, 88%. And 12% to cash. And this makes a lot more sense for a 30-year-old, by the way, just forgetting everything else, a 30-year-old saving for retirement. So now she has an expected return of 7.16%. That's obviously exceeds her goal a little bit. And yes, she has a lot higher standard deviation, right? So double, a little more than double standard deviation. So this portfolio is going to bounce around a lot, particularly because she's a 30-year-old and she has a long time to go for retirement. What has Julia done here? She deals with this short-term volatility. Even though she's conservative, she's dealing with this because she knows that she needs to invest in growth assets in order to achieve her goal, right? Because when we frame this around goals, all of a sudden, this short-term volatility doesn't seem so bad because feeling safe and having no chance whatsoever, right? Almost no 30-year-old alive, unless they have a ton of money, is going to be able to achieve their goal with a 63% allocation to cash, right? So maybe this feels good, but she has no chance of reaching her goal. Whereas in the second scenario, she does. All right. So we've got a couple questions. So why don't we pause for a second here and we'll see what questions we have. Hopefully they're mostly about Julia. Okay, so an anonymous attendee, our favorite attendee, says, so should asset allocation be based on a range of deviations, so standard deviations from low to high to create a balanced portfolio? Well, it depends. So it is a very good question. It depends what you're trying to accomplish. So what we would look for in a portfolio is the average standard deviation. So basically at the end of the day, you can take a weighted average, which is what I just did on that last slide. So if you have two different assets, obviously pretty easy, 50% in one, 50% in the other, just multiply that 50% by the standard deviation, and you'd have the standard deviation of your portfolio. Now, in some cases, and if we get into like more complex portfolio theory, then we are trying to find assets potentially that are moving in different directions, which would lower the overall standard deviation of a portfolio. So if we are talking to somebody who's running a hedge fund or either running another portfolio, that's what they're trying to do. So basically what they're trying to say is that the sum of the parts is going to be greater than the individual pieces. So what I'm saying here is that, you know, my weighted average theory of portfolio of standard deviation assumes that everything's moving in the same direction. But if I had two assets and one went up and one went down, that means the overall portfolio, when I mix those assets together, is going to be a lower standard deviation. So what I would say is that if you are a very long-term investor, I wouldn't worry as much about that, because just remember those assets that are going in different directions are probably going to lower that overall return. There are times when that's really important, right? Particularly as we're approaching retirement, times where low volatility really matters. So over long-term, volatility doesn't matter. All it does is really impact you psychologically, which could cause you to make a stupid move, like sell everything at the bottom of the market. But yeah, if we are looking at a portfolio that's being put together by a professional, they could consider how those assets move together. So Rory's asking, what is the definition of long-term, midterm, and short-term in relation to investing? Yeah, pretty simple. You know, what I would think about is the length of time until your goal at the end of the day. So, you know, if we're sitting there and we're looking at a kind of 3-year period to your goal, then yeah, I consider that pretty short term. You know, there is no kind of set definition, but you want to be careful about when we say short term investing, that if you need that money and you need that exact amount of money to achieve your goal in 3 years, then we're very worried about volatility. Then one of those outlier years, right? Even if we go back, not even an outlier year, we look back at what is within 2 standard deviations of that Vanguard Australian shares, that negative 18 something percent. So like, that's a huge problem, right? If I need money to buy a house, that's a huge problem for me if I have it invested too aggressively. Same thing as you're approaching retirement. Now, remember, retirement's a little bit of a tricky one. And we'll talk about bucket portfolios because it's a way to alleviate that a little bit. Because remember, retirement is like, in many ways, we all think about it, our whole working life as the destination, but it's not, right? It's not like you are taking your entire retirement portfolio and paying for something immediately at retirement. You got to keep investing through retirement. So it's a little trickier, but yeah, you do want to lower volatility because we talked about that sequencing risk, what happens earlier in retirement. So the anonymous attendee, first of all, said something nice about me. So thank you for that. And said, are you considering her super in these calculations? So Yeah, in a way I am. And I know the questions I'm going to get. So when I'm looking at these returns and when I'm looking at goals, remember, this is all assumes either you're not paying tax or after tax, right? So in all these calculations. So if she needed, in Julia's case, if she needed to access that money and had to pay capital gains tax when she sold it, that would be a problem. So we are thinking after tax. And I understand the issues, right, with super, where we're thinking about 1.7 million, everything else, and how much Julia had. I'm assuming as a 30-year-old that limit will increase over her lifetime. But I guess I would say I've been kind of considering super because that is a tax advantage, but not explicitly. I was just trying to make the point around risk tolerance. What is okay? So apparently, links are being put in to hosts and panelists. Okay, good. All right. Shawnee's just sending weird links of me wearing denim to other people. We'll get into, so we have a couple other questions that, okay, so Phil has a good Julia question. And then the other two questions I'll get to. It'd be useful to contrast Julia's case to someone at the age of 59. So yeah, listen, as obviously 59, we are getting there, assuming you're going to retire at 65 in this case, then yeah, all of a sudden we are getting very close to what we would consider short term. And volatility is going to matter. Now, I would argue that over 6 years, in most cases, depending upon how you've invested, that does give hopefully time for the market to recover. But that's where we really want to look at the different asset classes we're invested in, which we'll get to in a second. Because remember, the NASDAQ, so people keep telling me all this stuff. Well, I'll save my rant about that for later. But if we think about markets and we particularly think about the sort of speculative sides of the market, so the 2000 crash, it took the NASDAQ 15 years to get back to where it was, right? So something to think about. Everyone thinks markets recover almost instantaneously, but 15 years to recover. So that's why we need to be careful when we get down a level of asset allocation, which we are getting into. According to Shawnee, Mark is 59. Well, that's actually generous that you said 59. According to Shawnee, I can barely make it out of bed. All right, so let's keep going, and I'll get to some of those other questions because I think they'll be more relevant as we keep going. All right. So we want to diversify. So I was making a very simplistic point there, obviously, with two different asset classes, Aussie shares and cash. But we obviously want to expand that. And as I said, our investment management team has projected forward returns over the next 10 years. I'll talk about how they did that in a second. They've also projected forward standard deviations over the next 10 years. Now, at a high level, and we're going to get into some specifics once we go another level down, these are the different asset classes that we're looking at Morningstar. So, and you'll see we have some suggested asset allocations next, which obviously are all these asset classes. So why? Anyone who's looking at this list, the first thing that they're probably seeing, and the first thing that people are thinking about the markets, these are all a lot lower than what we've achieved in the previous 10 years. Now, why is that? And something to think about with the market where it is right now and the things that are happening. So one of the big inputs into projected returns is, of course, the amount of risk you're taking on in terms of volatility in different asset classes. But valuation matters. People keep telling you valuation doesn't matter, but go back and look historically. If you invest when there are very high valuations, that means that there are lower future expected returns. So you cannot go out and buy something that's very expensive and expect to get the same returns as if you bought something that's very cheap. So let's spend a second talking about this, because I think that it's a little bit of a misnomer, and it also It has to do a lot with human nature. And we talked before about how people's risk tolerance changes over time, and it changes based on what the markets are doing. And your risk tolerance actually changes in the opposite way. So let's talk about what this means. So let's spend a minute on it. So very simply, the way that humans behave is that when markets go up significantly for a long time, people actually want to take on more risk because they just assume, what do we want to call this, recency bias or whatever, they assume what's happened in the very recent past will continue to happen into the future. So they want to put more money into risky assets. Every single bubble, if you go back and look at it, the same thing happened. A ton of investor money, particularly retail investor money, went into the market at the wrong time. So it's happened over and over and over and over again because people's risk tolerances are readjusting in a bad way. They're wanting to take on more risk as the market has gotten higher and the market's more expensive. But in reality, buying something cheaper means that you have higher expected future returns. So when the market goes down significantly. So I'd still say a lot of what we've been seeing on the major indices is kind of noise, right? Like the S&P 500 corrected, meaning it was down more than 10%, and then like shot up at the end of the US trading day this morning, which was very strange. But yeah, go down a lot more than what it's gone down. But when there have been significant drops, that actually makes investing less risky. It makes it less risky to invest in shares. It won't feel less risky because everyone around you will be telling you how the market's gone down. You're going to lose all your money. All the media is going to be talking about all the problems that are going on. And there's always lots of problems. It's just what we tend to fixate on as investors. Yeah, it's one of the paradoxes of investing. So remember, it's actually less risky to invest when things are cheap. And if we think about, very quickly, I know I've said this a couple of times before in previous webinars, we think about where the sources of returns come from. If you're investing in a share, there are only three places you're going to get returns from, right? So the first place you're going to get return from is changes in valuation level. You buy a share that's trading for 10 times earnings, and later somebody's willing to pay 20 times earnings for it. So that rise in valuation, that the collective appetite of investors to pay more for a dollar of earnings in that share you bought, in that case, from 10 to 20, doubled the share price. So that's one way. Now, once again, what should be obvious is then if you buy a share at a low valuation level, the chances of somebody paying more for it in the future are much better than if you bought shares now, which are at historic highs in terms of valuation, and still are, even though the market's going down a little bit. Other place you get is dividend yields. Now, dividend yields, of course, go down as share prices go up. Because if the company is paying out the same amount of money in a dividend and you're paying twice as much for the share, your yield is twice as low. That yield matters. The yield matters when you buy that share on your purchase price. So dividend yields are lower when the market's high. We have record low dividend yields. The last place you get it from is, of course, growth in earnings. That if somebody's still willing to pay $10 a share or 10 times earnings for a share and the earnings double and they're still willing to pay 10 times and the share price doubles again. So think about that and think about what happens when you buy things at very high valuation levels. Well, two of the three sources of returns are potentially not going to happen or not happen as they've happened historically. So just something to think about. All right. So these are our expected returns for different asset classes. So that's what we want to look for, and we're putting together a portfolio. And then we have come up with 5 different portfolios, suggested portfolios. Now, once again, these are high level, and as I say, for all of this stuff, something that you need to dig a little deeper into. But everything from conservative, remember this is where Julia said she was, conservative, 85% defensive assets. So defensive assets are things like cash and fixed interest. So lower volatility. All right, we go back here. We look at these last 3 lines, fixed interest and cash, lower volatility, but lower expected returns. Those are defensive assets. Everything else up here is growth. So growth, higher expected returns, higher expected volatility, and you can see the different allocations that we have for each one of these portfolios. Point where we get up to aggressive, and remember, that's where Julia was. Basically, she ended up at 88% growth, 12% defensive. So an aggressive portfolio, which I think is appropriate for a 30-year-old with a 30-year time frame. As you get closer to retirement, you want to lower that volatility in your portfolio, even if you're giving up returns. That's when we start thinking about the different time frames. So where you can find this, by the way, and read more about it, if anyone is interested. It's always such a disaster when I try to find something on my computer. You think I would have learned my lesson, so we don't have these awkward pauses while I scroll through the literally 900 different, here we go, screens that I've open. So if anyone's looking for this, go into track investments, go into asset allocation models, and that's what we're looking at. So these are those same asset allocation models. You can read a little more detail about them. So that's that same allocation. So if anyone is interested in that, that's just where you can find it on the website. And I think all things considered, I actually found that pretty quickly. All right. So these are the 5 different portfolios that we have suggested. Now, here's the more complicated part. And this is, we have some questions about this. So let me go through this slide and we'll get into those questions. All right. Of course, asset allocation, those are very high level, right? Aussie shares, global shares, right? It's a big world out there. Listed property, you can read. Those are very high level asset allocations. Now we have to start thinking about, okay, what's a level down? And this is where things get pretty complex. Well, not complex. Complex is the wrong word. Here's where there's a little bit of nuance involved. You need to think a little bit about things. The first thing we need to look at is, and you hear this all the time from, passive investors, right? I want to own the market. So one thing to think about, of course, if we're looking at those equity investments and those, and infrastructure and listed property would fall within this as well. If we're looking at those growth assets, we say, I want to own the market. What is the market? Well, there is Morgan Stanley. So this MSCI all cap world index, that is the market. So all cap means all capitalizations. So that means big shares, which are large cap stocks, mid caps, small caps, medium-sized companies, small-sized companies. So every size companies, world index, every country in the world that has a share market. So this is everything. Most indexes are not everything. Most indexes are country specific. Most indexes that are global in nature are divided between emerging markets and developed markets. This is everything. Now, the reason we want to look at this is just so we have an idea of what the quote unquote market is. So this is the market. We look at country or county, as I wrote it, but I meant country, country, sector, style. So what does this mean? So the US makes up 60% of global market capitalization. That means if we add up all of the shares in the world, the US makes up 60% of the value of all the shares in the world. And you can see the other countries. Nobody's even remotely close. But you can see, you can see the other countries on the list. The other thing, of course, is sector. So we looked at sector. Technology dominates. So almost a quarter is in technology. And communications, a lot of communication services, a lot of these are what you would consider technology companies as well. So they are things like Google, for example, Facebook, they fall in there. So you can see technology dominates, especially when you add in communication services. We look at style, we've got a slight tilt. Well, we've got mostly core, obviously, but a slight tilt towards growth over value. So something to think about. The other thing that you should think about, particularly if you look at developed market indexes, now we're up to 70% US for thinking about developed markets. So why is this the case? Well, this case, of course, is that these numbers change all the time. And what has happened in the US? Well, the US has done very, very well. right? So something like you go back and look at the last 5 years or something, the US market's returned 18% a year. It's done very well. As things do well, they become bigger parts of the index. So just remember these things shift around. Now, there are very few people out there that probably are going to sit there and say, I'm just going to, quote unquote, invest in the total investable market, which this sector represents. And there's three reasons for that. And that's what some of these questions are. Number one, your personal circumstances. So if we sit here in Australia, we can see Australia makes up 1.72% of this index. Nobody in their right mind, as an Australian, is going to sit there and tell you that you should invest 1.72% of your money in Australia and the rest globally, right? You live here. Obviously, there are a lot of factors like currency, which will come into effect. There are certainly tax benefits from franking credits, things of that nature. So nobody's going to tell you that you should allocate this little to your home country. So that's one thing, that's circumstances. The other thing is strategy. And of course, the strategy that you're taking as an investor matters as well. That you need to come up with a strategy and an investment style that you're comfortable with. So strategy could be everything to, I personally feel more comfortable with a portfolio that is on the lower volatility side of the growth assets. So, and why? Because those are the type of shares that I'm comfortable owning. That's my investment style. So those are shares with higher dividends. So higher dividends, generally lower volatility. The size of the company generally lowers volatility. So bigger companies generally have lower volatility than smaller companies because they're more established, they have more product lines, they have better finances. I'm generally comfortable with that. The sectors you choose to invest in, especially when we add on those other layers of size and things like that, the sectors you choose to invest in are different, right? So things like consumer staples are not going to move around as much over the business cycle, right? So someone's going to buy a Coke, whether the economy is doing great or the economy is doing poorly. Maybe not other things, right? So we have more cyclical shares. Like, of course, resources are generally more cyclical. So all examples, so resources being materials right there. So all examples of finding something that you're comfortable in. Now, why does this matter? It matters because, once again, as investors, we want to be comfortable with the approach we're taking to investing, because if not, we'll freak out when things happen like what's happened in the past couple weeks. So if we look at the US market, for example, and what's happened in the past 3 months, and we talked about this a lot on our last episode of the podcast, and we'll do an Instagram post about it later this week. We've seen what's happened. Number one, there's been this rotation from growth to value, right? So in style. And the other thing is that if you look at small cap growth, has done really poorly in the past 3 months, something like 18% down. So these are all these technology companies that don't make any money that maybe someday will turn into the next Amazon. If that's the type of investing you want and you're comfortable in, then realize that's where you should allocate more. So this is all things that you should plan out in something called an investment policy statement, which we'll talk about later in this series. But it's really the approach you want to take in investing. And we will talk about this, particularly picking funds, ETFs, the next two sessions we have. So picking funds and ETFs and picking shares. We'll talk about how to find what's right for you. We'll talk about an investment policy statement. But just remember, you're probably going to deviate from this asset allocation. But it's important, no matter what you do, and everything you do investing, maybe most things in life, is do things deliberately. Right? Have a reason for what you're doing. If you want to go invest in small cap technology shares, then go for it. But just understand that they're small companies. It's a volatile sector where, particularly in that space, there aren't a lot of earnings, a lot of new companies coming out. Just realize what you're doing so that you're prepared for what just happened. So yeah, just some thoughts on asset allocation. So save the quiz. All right, so we've got some questions. So let's see how we go with these. All right. I've answered those questions. Here's some more questions. Let's see. most of them seem to be jokes about how old I am. Yeah, so Lisa's saying the 2008 crash took a very long to recover. Yeah, no, it did. So we're using the 2000 crash. I will say the 2008, if we look at the NASDAQ, for example, yeah, it didn't take 15 years. So that took a very long time to recover. Go back and look at the Nifty 50 crash. Happened in the early 70s. That took a very long time to recover. So it's as easy as just Googling like peak to trough crashes, and you can go back and see how fast things recovered every single time there was a bear market. But yeah, people shouldn't underestimate how long it does take potentially for markets to get back. Now, remember, one of the things that we saw in the 2000 crash, and maybe is going to happen now. Maybe it's happening. We don't know, obviously, what's going to happen. I don't know. But, when you see these rotations, so when you see these kind of pivot times in the market, like right now, for the last 3 months, there's been this rotation between growth to value. Everything that I showed you, like if we go back to this slide, there's no way to say whether this is normal or not. But as I said, the US, because the US has done so well since the GFC, has outperformed most other markets, the US has just increased and increased and increased in importance in global markets. So if we get a situation where the US resets to, and I don't know what reasonable is, right? There's no number for reasonable, but if we sit here in 10 years from now, the US is at 50% of global markets, that will be an issue for overall indexes, right? The average country could do very well, and the index could actually do poorly because the US has underperformed. So because it has been so long since the last rotation, like anything else, things get out of whack. Right? I don't know how much technology should be. All I do know is technology has grown significantly. So when we start talking about indexed averages, like if we go back and look at the 2000 crash, same thing happened. Obviously, the NASDAQ was a disaster. But if you go back and look at the S&P 500, as technology became more and more, as technology did really well. So in that dot-com run-up, right, before the crash, technology became a bigger part of the index. So when technology did horribly, right? So technology and communication services, so WorldCom, in communication services, Global Crossing, those companies that went out of business. So when technology did poorly, communication services did poorly, the index overall did really poorly. But if you looked at what actually happened, is there was this rotation back to value, and value actually did decently. So it's one of those situations where, what's represented by indexes, remember, it's not the average share. It is how the index performs is driven by the largest shares in it. In that case, the largest country in it. This will be driven by the US. So just remember, that's what happens with indexing. All right. So let's see. What else do we have in here? So Shawnee's missing. I don't know what she's doing. I'm seeing emails come from her. I guess she's just not paying attention, which isn't very nice. So Roy's saying, are these projected return rates available for 3 years, 5 years, and 7 years? They might be 5 years. Let me check. So Roy, if you send me an email at mark.lamonica1@morningstar.com, I'll check. I believe they're only 10 years, just because obviously what we want to do is take a long-term view on the market. And it's harder to project shorter time frames. Okay, so Shawnee is happy that people are making fun of my age. A question from Instagram. Sunny, if you buy high and the price goes down, should we buy more to average out? Okay, really good question. We're actually going to do a post about this, and something I was thinking about on my walk into work. So obviously we've seen a lot of, and hopefully most of you don't spend all your time following all of these different various social media forums, but we've started to see a lot of things come out on these forums. And I was thinking about talking to Shawnee about maybe doing a myth-busting podcast episode. So a couple of the things along the lines with what you're saying, Sonny, is that people are talking, they're saying a couple different things. They're saying buy the dip and And of course, around this whole dollar cost averaging, right, that the market's gone down. We'll talk about buy the dip for a second. Then they're saying that like shares are on sale. So these are my thoughts, but a couple of different things. Number one, buy the dip is a trading strategy. Like, let's be serious about what buy the dip is. So buy the dip basically means the market goes down a little bit and you buy. And this works very well in bull markets because the market, every time it retreats a little bit, then it goes to another high, which maybe is what's happening right now, right? So it works very, very well in bull markets. It works really, really poorly, like you run out of money and go broke in bear markets, because every dip, maybe there'll be a little rally, but every dip is just another stop on the way down. So it works really, really poorly in those situations. So in my opinion, buy the dip is a trading strategy, and I'm not a trader, right? So what I would much rather have people do is come up with a plan. And if the plan is to buy every single time that you get paid, all right, which is what super is for a lot of people, every paycheck you buy, stick with your plan. Don't change your plan. And changing your plan also means like throwing money into the market. The other thing that obviously that I reference that you hear a lot is shares are on sale. Well, I have news for people. Shares are not on sale after they've fallen 5%. It doesn't make a difference, right? We are at historically high valuation levels still. Even with what's happened, shares are not on sale. I don't think anybody sensible would sit there and say shares are on sale just because they've gone down a little bit. Like, when shares are on sale, we'll tell you when shares are on sale, but we will look at valuation numbers and we can figure out when shares are on sale. They are not on sale versus any sort of historical figures. That doesn't mean they're not going to go up, but they're not on sale. And it's just sort of this reflexive action that I think people are making. So I just be careful, Sonny, with what price going down means. Make sure that it's a meaningful fall. Yeah, so good. Okay, good comment by Linda. I like to think of the share yield. So what the price was I paid for the share, and I'm not unhappy, and the yield seems to have gone down when the share price goes up. Yeah, it's something that's interesting. It's just, think of it. So we always think about dividend yields, and dividend yields are like a good proxy, right? That once again, if you think about investing in terms of income and how much income you're generating from that $1,000 you put into the share market, right? That, when share prices go down, and all of a sudden I'm getting more income for every $1,000 I put in there. Like, it's not a bad way of thinking about the world. And what we would really look at is earnings yield, right? So sort of the opposite of a PE ratio. You're literally just doing the opposite math, but earnings yield, that like, what am I getting for my money? How many dollars of earnings am I purchasing for my money? You're just dividing that by what you put in, right? So think about that. It's a good way to think about the market, particularly a good way to think about the market if you are reinvesting dividends. Because I remember during the GFC that, yeah, I was just sitting there, like, obviously the markets were not doing well, but sort of to keep myself sane, I just thought about this. Okay, well, I'm reinvesting the dividends on all my shares. Like, I'm getting a lot more every time those dividends pay out. So yeah, something to think about. Lisa says, confident people are unaffected by negative comments on their appearance or age. Wow, Lisa, I must have missed the negative comments on my appearance. I'll have to go back and read the chat. So Kathy's saying, is China in other? Yes. So sorry, back on that slide. So we're looking at that slide and we had a bunch of countries and we had other. That other is a lot of countries. So there are a lot of countries that fall into the other. So I don't remember exactly off the top of my head, but I think I still have the screen open. It's one of the advantages of never closing any of your screens. Yeah, there's a lot of countries in other. So that is, yeah, that's where China is. What is the financial sector? So basically, Mandy's asking that. So the financial sector is a very big part of the Australian market. So financial sector are banks, insurance companies, investment managers. That's what's in financials. What happens if you throw investment properties into the mix? All right, so very good question, John. So yeah, I think it. Listen, I think it depends upon sort of the approach that you're taking to those investment properties. So I would argue that if you go back over the very long term. Obviously not what's recently happened. If you go back over the very long term and look at investment properties and look at how they perform, particularly when you're looking at real performance. So if we're looking at against inflation, that the property itself is probably more of a defensive asset. If you borrowed money, which let's be serious, almost everyone has to buy an investment property. If you borrowed money, that of course pushes it way into the growth category. So one of the reasons that investment properties, why people have done so well on property, of course, is the fact that there's leverage involved. So the fact that you are borrowing only a portion of the money, and then or you're borrowing a big portion of the money, you're only putting down a little bit as down payment, that kicks investment property way into the growth category. Just like if you went out there and borrowed money to buy shares, that is going to increase the volatility, because remember, you get big losses. If you go out and buy a property goes down. You buy $1 million property, right? You put down $200,000 and all of a sudden that property goes down 10%. You've lost 50% of the money you put down, right? Obviously, it's a short-term loss. So just remember, leverage is going to increase the volatility of anything, whether you borrow money to invest in shares or borrow money to invest in a house. So yeah, I would count anything that you borrowed money for in the growth phase. Just remember though, as you pay back that mortgage, and I know that's what makes buying investment property so attractive, right? That you're paying down that principal. As you pay it off over time, it's probably moving, well, it is moving closer and closer to defensive. So if you fully pay off that investment property, then yeah, it's probably a defensive asset if we go back and look historically over a long term at what property has increased at. All right, so another good question by Mandy. So she is saying, do you know the impact that ethically related investments play in the market? All right, so I'll spend a minute talking about this, and I'll stay on past 3 to answer the questions because I have nothing better to do. Obviously, feel free to drop off. So let's think about ethically related investments. So a couple things, basically what ESG investing is. So if we're looking environmental, social, governance factor, what it really is at the end of the day, the way it's applied by most people and what most people think it is an exclusionary list, right? To invest ethically means that we go through and we take out a bunch of companies that don't align with, well, hopefully our values, but basically the values and the mandate of the investment manager that's removing them. So, all right, we remove coal, great. So now we're not invested in coal. So let's think about what's happened with ESG. If we go back and we look at how ESG investments have performed, they perform pretty well. But they perform pretty well because a lot of the things that have been taken out have not done well, right? So a lot of ESG automatically excludes anything in the energy sector, right? So we're like knocking that whole sector out. Energy has done okay lately, but if we go back and look back over the last 10 years, hasn't done great. Where have a lot of these portfolios, once we remove all this stuff from them, where have they been tilted? They've been tilted towards technology companies. Now, people are starting to redefine that, and some people are taking Facebook out, for example, and things like that, but it's included in a lot of ESG indexes. So technology companies have done very well. So ESG has done very well. But just think about what's happening now, right? Like, I am willing to bet that if what happens right now continues, we're going to be having a discussion in 6 months' time talking about how poorly ESG is done because it's over allocated to these growth industries. So just something to think about. Anytime you remove something from the overall investable universe, it's obviously going to have an impact. So to say ESG investing has no impact on returns, yeah, it hasn't, But just remember, we are removing things. So I would say the impact that it's had on returns has been positive so far. So you're not giving up returns, but just remember what happens if we have that rotation. Same thing about knowing what you own. Shawnee says she's multitasking. Okay, we have a question from Facebook. Stock picking or ETFs for novice investors? All right, so yeah, good question. So let's talk about that. So it is difficult to go out there and obviously put together a portfolio of shares that outperforms an index. I will also argue that maybe that's not what you're trying to do. So when we sit there and we look at goals-based investing, we are trying to invest to achieve a certain goal. There are obviously ways that you can build your own portfolios without going into an ETF. I think one of the issues about ETF investing is ETF is a vehicle, right? So at the end of the day, like I know people are obsessed with ETFs because they're easy to trade, but the question is, how are you using that vehicle? If you're going out there and buying a broad index of an ETF that represents a broad index, then yeah, if you're a novice investor, that's probably the best place to start. It's probably best to start passively. And then as you learn more, if you're interested, start adding some individual shares to that core portfolio that's passive. But most ETFs that are released now are not those ETFs. So if you're out there picking ACDC or all these thematic ETFs, you might as well be picking shares. You're doing the same thing, right? Like you're doing the same thing, just packaged in this like marketing wrapper that's going to make you that is going to probably induce you to go out there and invest in something you don't understand, which is the same problem with investing in individual shares. So that's a little bit of my soapbox around ETFs. It depends how you do it. So I think novice investors, passive investing is a pretty smart way to start out, but that's just not what most ETFs are these days. So we've got a question saying, how do you calculate risk for your portfolio while talking about a different index? So if we're looking at indexes, right? So like if we're looking at an overall index, we of course can just go and look at, so here, I'll share my screen. So you can use a proxy. So basically you can use I remember how to share my screen, I think. You can use a proxy for an index. Go out and find an ETF. It's an easy way to do this. Go out and find an ETF. So this is that same thing, this iShares, MSCI, all cap world index ETF. This is a US ETF, by the way, but I couldn't find one in Australia that had this index. So this is the ETF page, right? So this is iShares, this is the BlackRock page, portfolio characteristics. Now they're looking at a different time frame than I am. They're looking at 3 years, but standard deviation, 17.09. So I was showing 5-year standard deviation when I looked at Vanguard Australian shares, but you can go look at an ETF and look at the standard deviation, which basically will correspond with the portfolio. So that's how you can look at different indexes. So figure out the index, go look at that standard deviation. If that's the way you want to look at risk. All right, let me try one more thing that maybe will be helpful. And then I think we've got a couple more questions. Sorry. So this is where the screens. Bruce says iShares. Yeah, iShares. BlackRock owns iShares. That's why I said BlackRock. But yep, there's some questions about if this is recorded. So there are links in there. So Robert's saying, do ETFs accelerate losses in a falling market? Okay, so once again, we don't know, but let me hopefully share some thoughts that let me share some thoughts. So we have never been in a falling market with this much passive money. So since the GFC, there's been this huge upsurge of passive investing. So if you look at US assets for now, over 50% are held passively. So we don't know there are people that say, and I think this may make a little bit of sense, there are people that say that the amount of passive money in the market is going to destabilize it. And it's going to destabilize it for the reasons, if you go back and listen to our podcast from Sunday, of sort of the scenario we walked through, a hypothetical scenario where, once again, a small group of shares, technology growth shares, large cap technology growth shares in the US that have done so well that if there's a sell-off in those, that is going to pull the average down. So the index, pull the index down, or even though most shares still might do okay, kind of like what happened in 2000, it will pull the index down. Then if passive investors start selling, that could accelerate losses, right? Because they are not, as a passive investor, I am not looking at a particular company. I can't sit there and say, well, Apple share price went down, but they're still selling a bunch of iPhones. This is a temporary like repricing of the valuation in an Apple share. I'm not going to sit there and think about that company and think about if that company is still doing well. Forget the share price. If the company is still doing well, I could potentially, it's a one button sale, right? I get spooked and I sell. So I think that there are some legitimate worries that passive investing, which did very, very well on the way up, as these same shares did better and better and better, these same large US technology company shares in the US kept doing better and better, dragging these indexes up, that the same thing could happen on the way down. So yeah, Robert, I don't know. We don't know, because we've never been in a market, never been in a passive dominated market like this. What that basically means is there are less bargain hunters. There are less active managers and individuals making individual calls on shares, on particular share. They're going to come in and stop the market from falling, right? So at some point, what has always happened, at some point, people are going to go in there and say, this share is a huge bargain. I don't know what it's going to take passive investors to do that. So we don't know. So anything could happen. So the anonymous attendee is saying, why are listed property and infrastructure separated out from shares? Is it because they're less volatile? Yeah, so what I would say is they have different characteristics, and their characteristics are different enough that we are going to put them in different categories. Now, they're still within, obviously, when you talk about listed property, for example, we were talking about real estate investment trusts, which are in the real estate sector that trade on the share market. Same thing for infrastructure, right? Infrastructure shares, Transurban trades on the ASX, it's an infrastructure share. They are just classifications, but they do have different characteristics. Both of those sectors, and we did a whole podcast on them, both of those sectors would generally do pretty well in an inflationary environment. They generally have high debt. They generally have more stable cash flows. And because they have different characteristics, we're going to put them in different categories to sort of call out that, all those sectors, cyclical, all the sectors, depending on how they move based on the market. Just a little bit different than those very specialized sectors that have very unique characteristics. So hopefully that helped. All right. I think we've got a couple more. So Carrie's saying, give some examples of ESG shares. Listen, I think, once again, most shares, I guess, would qualify as ESG shares. Normally, we just exclude things. So every company, every ETF provider, fund provider, et cetera, uses slightly different criteria. What I would argue, of course, is, what is the only criteria from me that is ethical investing is things that I care about, right? So, when we sit there and talk about, like, generally we'll exclude alcohol, for example. Like, I think it'd be pretty hypocritical of me, who does drink, to not own alcohol shares because I have a moral problem with it. That's only me. So I think it's whatever your criteria is, but go through and read the criteria that's listed and compare. Like, go in and compare, and you can compare sectors. Take an ETF that invests ethically, and then an ETF that doesn't, tracking the same index, and compare those different sectors. And you'll start to see what gets taken out. So generally, all of energy is gone. So you've taken out all the energy shares, and then you'll see sort of those other sectors that are generally underweight in ESG. technology is generally pretty overweight, right? So a good example, Facebook's a good example. Tesla has been excluded from ESG indexes. So some people think that that's insane because they're making electric vehicles. And some people think, well, batteries and everything else that they're producing to go into this, they're still car makers, which is not great for the environment to actually build the cars. Like everyone has their own opinion. It's one of the problems with ESG. So yeah, something to look at. All right. So it is 10 minutes after now, and people are dropping off. So I think I'll end it. Anyone who has a question, I know there are a couple other ones in here, which I will try to capture. If anyone wants to send me questions to mark.lamonica1@morningstar.com, it's on the invite. Send those around, and I'll send out an email later today that will have the recording, the materials, etc. So anyway, thank you guys for joining. If I didn't get to your question, I'm sorry. Just didn't want to go too much longer. But anyway, I appreciate it. And thank you for all the jokes about my age, mostly from Shawnee. But anyway, I hope everyone has a good day and